If you could distill, I don't know, weeks of patient waiting and really sophisticated market analysis into a single trade, what would that look like? I mean, a trade that's not designed for a quick scalp, but for a 200, 300, maybe even a 500 pip explosive move. Today, we're taking a deep dive into exactly that blueprint. We're pulling directly from the 2016 ICT Private Mentorship Core Content Month '06, which provides this really high probability framework for the classic swing trade. Our mission is to give you a concise, executable, and highly filtered process for those trades that are, well, designed to run for weeks.
That's right. And when we use the term swing trading here, we're talking about capturing market movement that's caused by significant institutional money flow.
So these are not the little intraday fluctuations.
Not at all. We're looking at holding periods often stretching from 2 weeks to, sometimes 6 weeks or even longer. The key differentiator is the objective. It's that 200 to 500 pips of profit potential.
And crucially, that potential, it only exists under very specific circumstances. We're not interested in lazy markets or that lethargic chop you see.
Right, or just range-bound consolidation.
Exactly. To even consider a swing trade, we need a market that is either clearly trending or one that has just violently left a consolidation zone. It has to show what we call displacement.
And that initial aggressive surge, that's the signature. It's the signature of institutional action, and it's basically telling you that the major direction is now set.
Okay, so once you see that, where do you even begin?
Well, it forces us immediately to establish our bearings. Before we even think about buying or selling anything, we have to define whether the current price is cheap or expensive.
And this is where the PD array matrix comes in.
Exactly. You can think of it as a conceptual map. Are we currently trading in a premium so expensive territory where we look to sell? Or are we in a discount, which is cheap territory where we look to buy?
Okay, let's break that down then. Let's focus on the discount side for a long trade because that's where the opportunities are born. The source material outlines 7 key bullish PD arrays.
Potential support or reversal zones.
Right. Zones that price will seek when it retraces into a discount. Now, that's a long list, so maybe we can just focus on the concepts behind, say, 3 of the most critical ones.
That's a good idea. For example, let's start with a bullish order block. This is essentially the last down candle right before a major aggressive institutional move higher.
So it tells you exactly where the big buyers stepped in.
Precisely. Then you have something like a liquidity void, which is crucial because it indicates that price moved so fast, so aggressively, that it didn't leave behind a smooth price delivery structure.
It's like a gap.
It is, and that gap often needs to be filled, so it acts as this powerful magnet for a deep retracement.
And then connecting those two ideas, you have the bullish breaker. This one's interesting. It's often an old low that was violated, right? So it triggers all the stops.
It cleans out the liquidity, yeah.
And then price immediately snaps back above it. So that broken support now flips its role and acts as this really powerful future support. It becomes a breaker of the old market structure.
Exactly. And these arrays, along with the other 4, the mitigation block, fair value gap, rejection block, and old low or hyponum, they basically define the entire discount zone for us.
But just seeing one of these arrays isn't enough.
Not even close.
Yeah.
Now we move to the really critical concept, higher time frame sequential alignment.
The synchronization. I think this is where the real power in this framework lies. I mean, if you're aiming for 500 pips, you just can't have the shorter time frames fighting the longer ones.
Think of it like navigating a massive oil tanker. The monthly chart, that's your underlying ocean current. It defines your ultimate macro direction.
Okay.
Then the weekly and daily charts, those are like the weather patterns and the tides.
Yeah.
They confirm the stability of that current.
So where does the 4-hour chart fit in?
The 4-hour chart, that's your precise rudder movement. That's what gets you across the harbor line, right at the perfect time.
So the easiest, highest probability setups only happen when everything is aligned. Monthly, weekly, daily, and the 4-hour are all in the same program.
Yes. For example, all bullish. They're all moving away from those discount arrays we just talked about and targeting the premium arrays up above.
So if the tanker is heading north, you're just waiting for the tide to pull back south just a little bit, just enough for you to get a cheap entry before the main current takes you north again.
Precisely said. The higher time frames, monthly, weekly, daily, they confirm the macro direction and your potential objective. The 4-hour chart is solely the entry vehicle. That's it.
So you're just waiting for that 4-hour to dip down into a discount array that you've already mapped out on the bigger charts.
You are. You're confirming your sniper entry point.
Yeah.
You're letting the biggest current do all the heavy lifting for you.
Okay, so once we have that directional bias locked in, we can move on to filtering. Because not all of these alignment setups are created equal, are they?
No, absolutely not.
This is where we need the hallmarks to explosive swing trades, that sort of advanced screening checklist that filters for only the most dynamic, high-velocity moves.
This is your high probability filter, and it starts macro. Major market analysis. This requires us to look beyond just the asset we want to trade.
Okay, what do you mean?
We need at least two of the four major asset classes, so interest rates, currencies, stocks, and commodities, to exhibit a clear, strong, trending profile.
And why is that so important?
Because if major markets, like, say, bonds and equities, are both just stuck in some choppy consolidation, it signals a lack of institutional consensus.
Ah, so any move in your currency pair is likely to be weak or tentative.
Exactly. You need confirmation that the big money is actively allocating capital across the board.
Okay, so that's hallmark one. What's next?
Next, we incorporate time itself, the seasonal tendency. Swing trades really thrive on these powerful, repetitive historical patterns.
Can you give an example?
Sure. Knowing that gold, for instance, historically experiences a very strong rally from December into early March,
Wrong.
well, that adds a tremendous amount of confidence to a long setup that you initiate in late December. That historical roadmap is a major confluence factor.
It's like having the wind at your back.
It is. Then, moving into institutional positioning, we use the Commitment of Traders Report, or COT hedging program alignment.
This sounds complicated.
It can be, but fundamentally, you're just looking at the commercial traders, the producers, the farmers, the giant multinational banks, and you're analyzing their net positions over the last year.
And what are you looking for?
You're looking for confirmation of their smart money bias. If we're planning a bullish move, we want to see clear evidence of commercial short covering.
Meaning they're closing out their short hedges.
Yes, aggressively, because they anticipate a significant price increase. Their hedging activity should confirm the direction you want to trade.
And tied directly to that is the open interest filter.
Correct. When commercial traders are buying back those short contracts, the open interest, which is just the total number of outstanding contracts, will often decline sharply. Usually 10 to 15% or more.
And that drop is like an X-ray, showing you the smart money is reducing their downside exposure and getting ready for the upside.
It's a huge tell.
Eh.
And then finally, the move itself must be preceded by silence. We look for the volatility filter.
So you're saying explosive moves are born from quiet periods?
They usually are. They rarely start from nowhere. We hunt for clear volatility contraction, like an inside candle or maybe the smallest trading range you've seen in the last 3 or 7 days. That coiling action suggests the market is, holding its breath right before a huge directional expansion.
Wow, that's a $5 million checklist right there. And the philosophy here seems to be just pure discipline.
It has to be.
So if a potential setup, even with good PD arrays and alignment, fails to meet these 5 hallmarks, you just skip it.
You skip the swing trade entirely. If the macro markets are choppy, or the seasonal is wrong, or the smart money isn't positioned, you might day trade it, sure, but you wait for these pristine conditions to ripen for that big long-term move.
It really does change your relationship with the market, doesn't it?
It does. You are no longer chasing. You're waiting for the perfect confluence of events.
And that focus on selectivity brings us to, I think, the most important part: reducing risk and maximizing reward. This is the core mindset of a professional trader.
It is. The whole framework is designed to find very low-risk entry points for absolutely massive potential returns. And the foundational rule here is framing every single setup with the R multiple mindset.
R multiple.
The minimum acceptable target for a professional swing trade is a 3-to-1 reward-to-risk ratio.
That's such a powerful number. I mean, if you demand a 3-to-1 minimum, it mathematically means you can be wrong 2/3 of the time. You can lose 66% of your trades and still be marginally profitable.
It radically changes the pressure on any single trade.
It has to.
But the goal isn't marginal profit. The real beauty is that because we're framing our trades on powerful, high time frame structure like monthly or weekly PD arrays, the entry precision we get from the 4-hour chart often allows for ratios of 5-to-1, 8-to-1, or I've even seen 10-to-1.
Okay, so let's talk about how that precision really pays off. Let's say your monthly chart identifies a really strong bullish order block.
Okay.
By waiting patiently for the 4-hour chart to tap that level exactly, you might only need a tight, say, 70 pips stop loss. If that trade is targeting the next weekly liquidity void, which is, 585 pips away, You've just framed an 8-to-1 R multiple trade.
All just by being patient and precise with your entry.
Incredible. So once you're in the trade, what about management?
Right, the management protocols kick in. The rule of thumb for your stop management is crucial for protecting that R multiple. You leave your protective stop loss at its initial position until price has moved 1/3 of the way towards your final objective.
1/3. Okay. And when do you move to break even? Because I think a lot of retail traders rush this step.
They do. The established rule here is you move your protective stop to break even only after you've taken your first profit.
So you have to bank something first.
You have to. You should scale out, say, 20 to 30% of your position at the first quarter objective mark. That way, you've locked in some profit before you eliminate all your risk.
That's smart.
And furthermore, experience tells us that markets are just designed to trick the weak hand. So knowing this framework, you have to anticipate a move that often stops near the 50% equilibrium point of the entire swing before it continues to the objective.
That's fascinating, but how do we as retail traders know when that stop run is just a necessary retracement versus, well, versus when the trend has just completely failed? That midpoint retracement is where most people would panic.
And that's fair. It comes back to your initial framework. If your higher time frame analysis is solid, if the monthly and weekly charts are still aligned and those macro market conditions haven't changed, you trust your original structure.
So the 50% retracement is just shaking out the weak buyers.
That's all it is. Now, if the market violates the initial discount array you entered at, that is when the structural bias is broken. Not just on a 50% pullback. You have to trust the structure you entered on.
That distinction is so key. Okay, all this theory, all this analysis, it's just information until you translate it into a structured, rule-based process. This is why the mentorship content so strongly emphasizes creating a mock trading plan.
Yes.
Yeah.
This conceptual exercise is the essential bridge between just having knowledge and actual execution. It helps you internalize the process and remove that emotional impulse from your trading. And it has to have 5 components.
Okay, what's the first?
First, you have to clearly outline what constitutes an initial opportunity.
Yeah.
What combination of macro news or seasonal patterns or major displacement first catches your eye and makes you even open your charts.
Second, you need to identify a valid trade setup for a swing trade using that sequential alignment model we talked about.
Yeah.
You have to prove the monthly, weekly, and daily charts all agree before you even look at the 4-hour.
Third, determine precise profit objectives. And these targets have to be static and rule-based. They have to be defined by clearly identifiable, higher time frame, premium or discount arrays, not a gut feeling about where price might go.
Right. And fourth, frame the risk management with absolute clarity. This includes your specific risk percentage per trade, your total exposure limits, and the exact step-by-step rules for moving your stop loss and taking partial profits.
And finally, the most critical step for eliminating mistakes, defining the step-by-step filter process. This is where you actually write down your high probability checklist, your 5 hallmarks, and ensure you eliminate any low probability opportunities before you ever place an order.
Doing all that work in advance, it forces every decision to be based solely on price information and your own rules.
Exactly. It's about being patient enough to wait for the alignment and disciplined enough to stick to the entry precision.
You know, the best part about this entire swing trading model is its efficiency. You dramatically reduce your trade frequency. You might only find one of these A-plus quality setups every, 4 to 6 weeks on average?
That's about right. But in slowing down, you dramatically increase your potential returns with minimal account risk exposure. This is how profitability becomes achievable without the constant burnout that's associated with high-frequency trading.
The power lies entirely in trusting that sequential analysis and applying that really stringent multi-point screening checklist.
It does.
So as you start to build your own structure around this framework, which hinges entirely on identifying that long-term directional bias, here's a provocative thought for you to consider. Since you know mathematically that the 3-to-1 minimum allows you to be wrong 66% of the time, how would adopting a mindset of being willing to be wrong multiple times, as long as it's in the direction of the monthly trend, fundamentally change your approach? If you expect a few small stop-outs while you're hunting for that one massive 8-to-1 winner, you're trading the trend with confidence, not fear.